Ladies and gentlemen, let's talk about one of the most overlooked, most emotional, and most powerful elements of building a business, shares management. Now, when I say shares, most of you immediately think ownership. And you're right, that's exactly what it is. But what people forget is that ownership means power, it means leverage, and more importantly, it means responsibility. In the first few years of a business, the conversations about equity usually happen late at night, over pizza, between two co-founders who have a dream. There's energy, there's excitement, there's hustle, but very little strategy, and I get it. I've been there. I know how tempting it is to say, let's just split everything 50/50 and figure it out later. But let me tell you something, that's not a business plan, that's a conflict waiting to happen. When you manage shares with intention, you're not just distributing ownership, you're defining culture, loyalty, and leadership. Every percentage point should represent a decision, a commitment, a contribution. Here's the mistake so many early-stage entrepreneurs make. They hand out shares like they're stickers. They give 5% to a friend who made the logo, 10% to someone who gave advice over coffee, and before they know it, they only own 42% of the company they built from scratch. That's not generosity, that's a lack of vision. Ownership should never be a reward for being early. It should be a reward for being essential. And if you're not defining that from day one with contracts, vesting schedules, and clarity, then you're setting your company up for drama, dilution, and distrust. Let me give you a real example. A startup founder I coached came to me in a panic. She had given 25% of her company to her college roommate because he believed in the idea. He didn't build the product, he didn't recruit the team, he didn't show up every day, but now, years later, he was blocking funding decisions because he had voting rights. That's not partnership, that's paralysis, and that's why shares management isn't a financial strategy, it's a leadership strategy. So how do you get it right? First, decide what each role is worth not just emotionally, but strategically. What value does that person bring now, and what will they bring in 12 months? Equity should be tied to outcomes, not history. Second, use vesting. If someone leaves after 6 months, they should not walk away with 10% of your company forever. Set up a 4-year vesting schedule with a 1-year cliff. That way, they only earn equity by staying and contributing consistently. Third, educate your team. Too many employees hear the word stock and think they're rich. You need to explain what preferred shares mean, what dilution means, and how exit scenarios actually work. Don't hide the truth behind flashy option packages. Transparency builds trust, and finally protect your cap table like it's your mission. Because it is, the moment your ownership gets scattered, your vision starts to blur. You need to know who's sitting at the table and why. Every shareholder should be someone who shares the risk, the grit, and the grind. Ladies and gentlemen, shares management is not about greed. It's about growth. It's about understanding that the people who own your company will shape its future. So choose wisely. Document everything. Talk early. Align always, because the minute you give someone equity, you're not just giving them a piece of your company, you're inviting them into your legacy. So ask yourself, is your cap table a reflection of your vision? Or a record of your mistakes? It's never too late to fix it. It's never too early to be smart. Manage your shares like a leader. Build your team like a founder, and protect your equity like your life depends on it, because it kind of does. Clarity is power, especially when it comes to shares management. In the early stages of building a company, there are countless decisions to make: product development, hiring, branding, and amidst all that, equity decisions often get rushed or overlooked. But here's the truth, the cap table of your company is not just a legal document, it's a mirror of your vision, your leadership, and your long-term planning. When you're not crystal clear about who owns what and why, you are planting seeds for confusion, resentment, and potentially devastating power struggles. Imagine this: two co-founders start a company. One is the visionary, the other is the technical builder. In their excitement, they decide on a 50/50 equity split. They don't discuss what will happen if one of them steps away. They don't define roles, responsibilities, or expectations. At first, everything feels fair. They're both working hard, aligned, and motivated. But 6 months in, life happens. One co-founder gets distracted, the other picks up the slack. Workloads shift, priorities change, but the ownership structure doesn't. Suddenly, one person is working twice as hard but owns the same amount of equity. Resentment grows, communication breaks down, and now their shared vision has turned into silent competition. Why? Because they didn't have clarity. They didn't have the tough, honest conversations up front. Clarity in shares management isn't about being cold or transactional. It's about setting everyone up for success. It's about defining the why behind every percentage point. When you give equity to someone, you're saying, I believe your contribution is essential to this company's future. That belief should be measurable, visible, and tied to real outcomes. When equity is handed out casually to a friend who introduced you to an investor, to someone who said they'd help with marketing but never followed through, it dilutes more than just your ownership. It dilutes your vision. When people know exactly how equity decisions are made, trust is built. Clarity gives your team a sense of structure and fairness. It removes emotion from the equation. It sets expectations and creates a standard. People stop asking for equity just because they showed up early. They start thinking about how they can earn it. That's the shift from entitlement to performance. And that shift is critical if you want to build a culture that scales. Now let's talk about investors. When your cap table is messy, vague, or cluttered with random early equity grants, you're sending a message that you're not in control, and that scares them. Investors don't just invest in your product, they invest in your leadership. They want to know that you've been intentional, that you've had the hard conversations, that you've protected the company's ability to grow and adapt. Clarity in share management isn't just about your current team, it's about your ability to attract future capital, talent, and partners. It also helps you as a founder sleep at night. When you're clear on who owns what and why, you're not constantly questioning decisions. You're not worried about surprise exits or silent partners slowing you down. You're leading with confidence because you've built a foundation that is fair, documented, and strategic. That's what clarity gives you: freedom to lead. So don't avoid the share conversation. Don't rush through it. Don't leave it until after the product launch or until you raise money. Do it now. Be transparent. Be firm. Be clear. Your future self and your future business will thank you for it. Ownership equals responsibility. It's not just a statement, it's a mindset that determines the entire trajectory of your business. When you give someone shares, you're not just rewarding them for showing up, you're handing them a piece of the power. That power comes with consequences. It comes with influence. It comes with a seat at the table, and sometimes even the right to slow things down or change direction. That's why giving away equity without real performance behind it is one of the most dangerous mistakes a founder can make. Equity isn't something you give out to make people feel good. It's something you assign with intention, with measurement, and with the long-term vision of the company in mind. Many founders fall into the trap of using equity to compensate for lack of cash. They say things like, I can't pay you much right now, but I'll give you 2% of the company. The problem is that 2% doesn't mean anything without clarity of responsibility. What are they expected to deliver in return for that ownership? How will that 2% evolve over time? Will it vest? Will it be diluted? Most of the time, none of this is clearly discussed. And the moment that person stops delivering, stops showing up, or decides to move on, they still own a piece of your business forever. Ownership without accountability is a leadership failure, not a loyalty gesture. It creates imbalances, confusion, and in some cases, legal problems that can stall your growth or scare away investors. Think of equity as a leadership tool. It should motivate people to think and act like owners. That means they don't just complete tasks, they solve problems, they take initiative, they protect the brand. They think long term. If someone's walking around with shares but doesn't feel a sense of urgency or responsibility to move the business forward, then your equity strategy is broken. And if you've handed out equity to people who were kind of helpful, but not truly committed, then you've traded long-term control for short-term convenience. You need to create a culture where ownership is earned, not expected. People need to understand that a share in the business is a share in the burden. It's a share in the risk, and it's a share in the consequences when things go wrong. You cannot reward potential. You reward performance. Shares are not about fairness, they're about impact. If you're not using data, outcomes, and tangible results to inform who gets what, you're operating on emotion, not execution. And let's be honest, responsibility doesn't stop at performance, it also includes behavior. Just because someone is a top performer doesn't mean they deserve equity if they're toxic to the culture, disrespectful to the team, or unreliable when things get hard. Ownership requires maturity. It requires integrity. It requires alignment with the vision of the company. That's why shares shouldn't just be a financial decision, they should be a values decision. As a founder, your job is to protect the mission. Every share you give out is a small piece of that mission being handed over to someone else. Are they capable of carrying that responsibility? Are they willing to earn it every single day? If the answer is no, they shouldn't have equity no matter how early they were, how smart they are, or how loyal they've been. Shares are not prizes, they're promises, and they come with weight. When you start treating equity with the seriousness it deserves, your team starts showing up differently. They stop acting like employees and start thinking like leaders. And that's when you stop building a company and start building a movement. Ownership equals responsibility. Make sure your shares reflect that. Have the tough conversations early. It's one of the most critical disciplines a founder or leader can develop when managing shares. It's easy to delay equity discussions, especially when everything is new, exciting, and full of momentum. You want to keep the vibe high, preserve the friendships, avoid the awkwardness. But the truth is, avoiding hard conversations in the beginning almost always leads to harder situations later. Equity decisions are emotional. They're tied to ego, identity, and a person's sense of worth in the company. That's exactly why you need to talk about them before the emotions run high, before money is on the table, before the company has traction. When there's nothing to fight over yet, you have the clearest space for honest alignment. Too many founders wait until it's too late. They've built the product, they've gained users, they're about to raise money, and suddenly they realize their co-founder, who hasn't contributed in 6 months, still owns 40%, or their early marketing lead assumed they were getting equity, but it was never formalized. Now that person feels betrayed and trust breaks down. Or worse, you find yourself at the negotiating table with an investor, and they're looking at your cap table with a raised eyebrow, asking why a former intern owns more shares than your current CTO. These moments are painful, and they're avoidable if you're willing to be brave and communicate early. Having the hard equity conversation doesn't mean being aggressive or dismissive. It means being transparent. It means getting in a room with your potential partners or team members and asking real questions. What are you contributing? What are you expecting? What happens if you leave in a year? What happens if I'm still working 80 hours a week and you're working 20? What does success look like for both of us? These conversations set the tone for your leadership. They communicate that you are building something serious and that you expect the same level of commitment from everyone involved. When people know where they stand from day one, there's less room for assumption and resentment. Expectations are clear, performance becomes the standard, and most importantly, your culture becomes grounded in truth, not just enthusiasm. Even if the conversation is uncomfortable, it builds trust because people feel respected when you're honest with them. It shows that you care enough about the relationship to define the boundaries. And let's be real, if you can't have this conversation now, how will you handle a real crisis later? Startups are not easy. Emotions will get tested. Pressure will mount. Equity is just the first of many heists. stakes decisions you'll face together. If you don't build the muscle for hard conversations early, you'll be reactive instead of proactive when it matters most. Another benefit of addressing equity early is that it forces everyone involved to think about the long term. It changes the question from "what do I get now?" to "what are we building together and how do we earn our place in it?" That's a huge shift. People start thinking like founders, not freelancers. They start planning their contribution in terms of value, not time. And you start attracting the kind of people who want to grow something, not just benefit from it. Delaying equity conversations might preserve comfort, but it erodes clarity, and clarity is what builds momentum, trust, and alignment. The earlier you draw the lines, the fewer fires you'll need to put out later. It's not about being harsh, it's about being smart. If you truly believe in your vision, protect it by facing the uncomfortable questions head on. Don't let silence and assumption be the architects of your cap table. Be bold, be clear, and lead with the courage to talk about the things that matter before they turn into problems you can't undo. Equity isn't free, it's earned. This is one of the most misunderstood truths in business, especially among early-stage founders who are eager to bring people on board and build fast. In the rush to build a team or express gratitude to early supporters, many entrepreneurs start giving away pieces of their company without clear expectations or accountability. They think equity is a gesture, a thank you, a motivational gift, a sign of trust. But what they fail to recognize is that equity is the most valuable asset a founder has. It is not a favor. It is a financial and strategic commitment, and it should only be exchanged for measurable, meaningful contributions that move the business forward. When someone is given equity in your business, they are no longer just a participant, they become an owner. That ownership doesn't disappear. Even if they walk away, they still hold that piece of your company unless you've set the right terms up front. This is why the concept of earning equity is so critical. There must be a path to ownership, not just a handout. When you give someone shares on day one, without performance, without a vesting schedule, without accountability, you're essentially betting your future on the hope that they'll stick around and do the work. That is not strategy, that's desperation disguised as generosity. The idea that equity should be earned creates a higher standard across your organization. It creates a culture of contribution. People start to understand that ownership isn't given for showing up, it's given for showing impact. If someone wants a piece of the company, they need to prove their value, stay committed, and align with the long-term mission, and if they're not willing to do that, they don't deserve the equity. It's that simple. Performance-based ownership helps eliminate entitlement, and it gives your team a clear path to grow into leadership not expected on day one. Founders often face emotional pressure when deciding who gets equity. Friends, family members, early advisors, they were there from the beginning. They believed in you, and that support can feel priceless. But there is a difference between appreciation and ownership. You can thank someone. You can pay someone, you can even offer bonuses or consulting fees, but equity, that's reserved for people who are helping build the company, not just rooting for it. You can respect someone's early encouragement without giving them a permanent stake in your vision. And if you don't learn to separate emotion from equity decisions, you will slowly lose control of your own company. Another important reason to treat equity as something that's earned is because investors will. When they look at your cap table, they want to see that you've been disciplined. They want to know that the people with equity are actually driving the business forward. If they see random names with large percentages who aren't currently active, it sends a red flag. It shows a lack of leadership and foresight. Investors don't just put money into ideas, they put money into well-run organizations with clearly defined responsibilities and clean ownership structures. Giving away equity too freely can destroy that credibility before you ever get the chance to raise capital. Ultimately, equity should be your most powerful incentive tool. It should drive performance, retention, and alignment. But it only works when people know they have to earn it. When your team understands that equity is tied to outcomes, not emotion, they take ownership of their results. They show up differently. They operate like leaders, not just employees. And that shift creates a stronger, more accountable culture, one that can scale. Giving away pieces of your company is one of the most serious decisions you'll ever make. Make sure those decisions reflect your values, your vision, and your standards. Because once it's gone, so don't give equity to make people feel good. Give it to reward those who build, contribute, and commit. Equity isn't free, and it shouldn't be. Protect the vision, because if you don't, no one else will. One of the most important responsibilities a founder has is safeguarding the direction, purpose, and integrity of the business, and nothing threatens that more quietly and more powerfully than poor equity management. Your cap table isn't just a spreadsheet, it's a reflection of who holds decision-making power, who influences your trajectory, and who gets rewarded when you win. If you're not intentional about who owns what, why they own it, and how they earned it, you're risking more than just your company's finances, you're risking its future. In the early days of a company, the vision feels untouchable. Everyone is on the same page, united by excitement, a big idea, and shared late nights. But time changes people, roles evolve, some team members rise, others fade, priorities shift, and when that happens, the vision can start to fracture. People who own shares but no longer believe in the mission still have power. People who were given equity without clear purpose now have a voice in decisions they no longer fully understand or support. And all of that begins to show in your company's culture, its momentum, and its outcomes. This is why protecting the vision starts with protecting the cap table. Every person who owns shares should believe in the mission and be actively contributing to it. If they're not, their presence on the ownership chart becomes dead weight or worse, a source of conflict. When your shareholders aren't aligned, your decisions become slower, more political, and less focused. Suddenly, you're negotiating internal issues instead of building the business. The original vision gets diluted, twisted, or delayed not by external forces, but by the people who were supposed to help realize it. Protecting your vision means making tough calls. It means not handing out equity just because someone asks for it. It means saying no to deals that compromise your values. It means revisiting past decisions and, if necessary, renegotiating or reclaiming shares when people haven't lived up to expectations. That's not harsh, that's leadership. Because your responsibility is to the business, the customers, and the team who are counting on you to deliver on what you promised. You can't do that if you're weighed down by equity decisions that no longer serve the mission. This doesn't mean shutting people out or hoarding ownership. It means being clear, fair, and strategic. Equity should be a tool to amplify the vision, not distract from it. When given intentionally, it brings in people who are just as obsessed with the outcome as you are. It attracts partners who think long-term, act with integrity, and make decisions based on what's best for the company, not just themselves. That's the kind of energy your vision needs to survive and scale. Every time you issue new shares, ask yourself, does this move us closer to the vision or farther from it? Is this person aligned, committed, and capable of pushing this business forward, or are they here for short-term gain, prestige, or past contributions? Vision-driven equity decisions are grounded in performance, future value, and shared belief in where the company is going, not sentiment or pressure. The companies that make it big, the ones that last, are the ones where the vision stayed protected at every level, from the product to the people to the cap table. As the founder, no one will care about your vision more than you. So make sure the people you're giving ownership to are just as serious about it, because once you lose control of your equity, you risk losing control of the very thing you set out to build. Protect the vision, always, even when it's hard. Especially when it's hard.